In today's combination tutorial and web lesson, I'm going to be covering trading calculators. They're a tool I've developed and used pretty much every day when I'm trading. As with all my trading tools, one of the most important things is to read the disclaimer first. These tools are for educational purposes only. They are beta versions and still under development, and so if you use them, you do so at your own risk. That said, I have made every effort possible to make sure they're accurate and error-free. There are two versions of this calculator. One is enhanced with XLQ and the other is not. Where there are differences in the calculators, I'll make sure to point them out. I primarily use these calculators to help me assess risk as well as manage open trades by keeping a tab on the P&L. As with all trading tools, wherever you see a red cell with a white asterisk, you'll find a note that contains helpful information and guidance regarding the trading tool. There are many tabs in this particular tool. If there's one that you need to get to that you don't see, you have an arrow button that can advance it. Very helpful to move back and forth throughout the workbook. The first calculator is capital allocation. It allows you to do up to 8 different calculations for multiple accounts. It's designed so that you can have up to 5 accounts and up to 8 for individual tickers. You have the ability to change the capital allocation. Anywhere you see a light colored fill-in, it's an area that you can change. So perhaps you only wanted to allocate 10%, 5%, and 3% of your capital to any given trade. This tells you what that capital would be. Then you can do a quick approximation of the maximum number of shares you would have without factoring a stop into it. So if the entry of the stock was $259, so a 10% maximum allocation would allow you to have at most 1,931 shares. Obviously you have to factor in your stop, but it can give you a rough idea of what ballpark of shares you're looking at. In the XLQ Enhanced version, the price of the ticker that you type in will automatically be entered and update. This is convenient because it saves time. You don't have to manually enter the price of the stock at the time that you're interested in it. The next calculator is a quick position size table. I get so many questions about how to calculate position size quickly intraday when people are trying to day trade in and out or scalp. This is certainly one of the best tools in a fast environment. Here's a quick example on how you would use this. Let's say you only want to risk or lose $500 a trade, and you happen to know that you're going to need a dollar stop. Where the two intersect is your position size. It's really that simple. So a $500 loss limit with a dollar stop, you can get 500 shares. If you're able to reduce your stop to 40 cents, you can get 1,250 shares. Now what's nice about this particular table is you can change the risk amount. If you don't see the amount you want to risk, you can just simply type it in. All of the blue numbers for stops and all of the green numbers for risk are adjustable. The next calculator is a position size calculator, and it offers a little more in-depth information than just the quick position size table. I tend to use this when I'm planning trades, swing trades, position trades, things like that, and I tend to use the quick position size table for day trades. Anywhere you see yellow, you can enter some data. You can enter the amount of capital you have, the percent of that capital you want to risk. Say you have $100,000, you want to risk 1%. That allows you to lose up to $1,000 a trade or to risk $1,000 a trade. There's many ways to calculate position size, and quite frankly, most of them are terribly boring. This next section addresses volatility and position sizing. So given the amount of capital you want to risk, and the size of your stop, and the price of the stock, the maximum number of shares that you could get without introducing the concept of volatility would be 97 shares. When considering overall risk, not only do you want to consider how much of your capital you want to risk and how large you need your stop to be, you also need to consider what percent of my capital is going into this trade. It's rare that you want to put all your eggs in one basket, and you may not be comfortable with using up to 33% of your overall capital for one trade. Part of a good money management plan is to set limits, and if this number of shares exceeds your capital allocation limit, then you'll need to reduce the size. This column addresses stock volatility, and then market volatility, and then stock and market volatility. So you can see that while you might get 97 shares when you don't account for volatility, when you do account for it, your position size will be smaller. In the XLQ Enhanced version, it automatically calculates all the volatility based on historic volatility. You can see that in the XLQ Enhanced version, the shares are slightly different. That's because it uses historic volatility to calculate the number of shares for the stock volatility, the market volatility, and both, whereas the non-enhanced version uses ATRs. In order to get volatility position sizing, you have to put in the ATR of the stock and the ATR of whatever index you're using, whether you're using S&P 500 or NASDAQ or Russell. Whatever is going to be your benchmark index, that's the ATR that you would enter. In the actual equity risk section, you put the number of shares, what the buy point was. It'll automatically calculate how much capital was required in dollars and percent, and then give you a balance on your remaining capital. The multiple position size calculator is the same in essence as the one we just covered, but it allows you to calculate multiple positions in an account. And if you take the time to fill out the actual equity that was risked, the share size, the pivot, it will keep a running balance of your capital from trade to trade to trade. Again, as on the previous tab, you'll need to manually enter your ATR for the stock and your index benchmark. The XLQ Enhanced version calculates everything on its own. The one bit of information you need to put in is who your XLQ data provider will be. If you're using it for intraday trades and you need up-to-the-minute information and data, you'll need to use a real-time data provider. That's Interactive Brokers, TD Ameritrade, or IQ Feed. If you're using it as a planning tool, at the end of the day, you can use Yahoo, which is completely free. The risk-reward calculator will calculate your risk-reward ratio for long or short trades. Maybe you scaled into this position. Maybe you didn't get all your shares right away. You put the entry price, your stop price. It'll show you what your per share stop is, as well as what the percentage is for that stop. The next thing you enter is your exit or your profit target, and it will automatically calculate the risk-reward ratio. It does the same with shorts down here. In the XLQ Enhanced version, simply put your data provider and the name of the ticker, and it will automatically give you the price of the stock. You've probably noticed that on every page you'll see a red cell with an asterisk. Click on it and you'll see that there's a note with helpful information regarding each calculator. This is the Quick R calculator. It calculates your R in an open or closed trade for short or long positions. Simply put the price that you bought the stock in and the amount of your stop. In this example, you entered at 108.52 and you used a dollar stop. It will automatically calculate all your plus R's and your minus R's for that short trade. It does the exact same for longs. If price falls to 107.52, you've made a gain of 1 R. If price falls to 99.52, you've made a gain of plus 9 R. If the trade moves against you and prices hit 13.52, you're down 5 R. This is the quick percentage calculator. It's structured the same as the last one we looked at. However, instead of R, it gives you a percentage of loss and gain for either a short or a long trade. If your pivot on a short trade was $100 and price fell to 95, that would be a 5% gain. If price rose to 107, it would be a 7% loss. In addition to this quick percentage table for gain and loss for long and short trades, there's also a very handy little percentage calculator. It addresses 3 common percentage calculations that most people use. The first is, what is 10% of 141? It gives you the answer. X is what percent of Y. So what percent is 100 of 500? It's 20%. If I had a stock that was 147 and it fell to 125, what would the increase or decreasing percentage be? It would be a decrease of 14.97%. I use it to calculate profit and loss. I use it to calculate pullbacks. It comes in handy. Some people have asked, why do you have so many different calculators? And it's because different people see things differently. Some people see certain things more easily than others. So it's nice to have many different ways of looking at risk and looking at profit and loss. This is the Open Positions Drawdown or Profit Calculator. You can have up to 5 accounts and you can have up to 4 simultaneous tickers. This works from a slightly different perspective. For example, if in one account you had 3,000 shares of a given stock, every time the stock fell 25 cents, you'd be down $750. If it dropped $1.50, you'd be down $4,500. You can see that both the first two deal with losses and the bottom two deal with gain. What's convenient about this is you can change the share size to whatever you want, and you can change the increment of your loss or gain. This focuses more on the price change since you entered and your share size, so that you can quickly understand how much you'll lose or gain with each tick that moves against you or in your favor. This profit loss table will tell you quickly whether you go long or short, what the price of the stock is at a certain percent gain or a certain percent loss. Perhaps the stock costs $50 when you entered and you're seeking a 30% gain, and you'd like to know what will that price be. That price would be $65. Where the two intersect, that's your answer. The green is long and the red is short, and you can change the price of the stock and you can change the percentage gains. Next up is a profitability profile. You can quickly find out your average win and loss ratio. You can put the date, whatever time period you're interested in looking at. Just jot down the number of profitable trades versus unprofitable. It'll tally your total trades and give you your average win rate. The profitability calculator, you put in the number of trades you've made. Perhaps you've made a series of trades. It could be 20. In this example, it's 100. And on average, you risk 1 and you make a reward of 3. If the average dollar amount that you risk is $1,000 per trade, that would mean that on average you risk 1,000 and you make 3,000. Well, if you know what your win rate is, and you should from up here, maybe you win 65% of the time, that will give you an average profit of $160,000 over 100 trades. You can take the same information and put it in here. If you know that you, on average, risk $1,000 per trade and your reward ratio is 3, so you make $3,000 per trade, you can put the number of trades in, or the sample size, maybe 20 in this instance, and you can get a quick snapshot of your risk-reward expectancy. So your win rate was 65%, let's say 60 to make it easier. You go to the 60% win rate and highlight it, and you'll see that on average your gross profit over a series of 20 trades would be $12,000. You'll make $36,000 on average, and you'll lose $24K on average. The last section is a quick average expectancy calculator. Enter your win rate. Perhaps you win 28% of the time. Enter your average win and loss. You can see that that's a win-loss ratio of 5. And it'll calculate your average expectancy. That means on average you can expect this strategy, in this example, to return 0.68 times the size of your losses. If it's a positive number, you can expect a positive return. Another thing that's nice about this is you can take this number and compare it to the number you get using different strategies to help you figure out which ones are performing best. Next up is the adding to a position calculator. Like the other calculators, you can change the numbers in the green column as well as the blue column. And here's how it works. If you're already in a trade and you want to add to a position, you find how much profit you currently have. Next, you figure out what percentage of those profits are you willing to risk to fund the added position. The better approach is to do a smaller position size than you currently have and to not use all of your profits. That way you have a profit cushion if the trade should move against you after you add. So in this example, we're willing to use 25% of our current profits, which are $500. And then we have to know what is our stop size going to be on this added position. If the stop size is 50 cents, then you can get 250 shares. In general, when you add to a position, it's better to get incrementally smaller and smaller position sizes. That way it keeps your cost averaging down. After that, there's the scaling in or out calculator. You can put up to 10 lots to enter or 10 lots to exit any given trade, and you have multiple tickers that you can keep track of. In the top column where it says lot, you could put the date if you prefer, or you can just leave it as lot 1, 2, 3 all the way to 10. Put in your shares, the price you bought the shares, and the commission fees. It'll average and add all your total shares, give you your average price, and give you a summary of the fees. You can use it for entering or exiting, and there's a place for notes, and if you wish to also annotate what account it corresponds to, you can do that. Our final calculator is the moving average conversion calculator. It's a quick converter. You go from a higher time frame to a lower trading time frame. What would a 20 EMA on the 60-minute chart be on the 10-minute chart? It gives you that answer, 120. This section addresses minutes again, but from a lower time frame to a higher trading time frame. Maybe you're interested in converting a 200 moving average from the 5-minute time frame to the 10-minute time frame. It gives you the higher time frame equivalent. That would be 100 EMA or SMA depending on whatever your preference is. The next category converts daily to weekly and weekly to daily charts. If on the daily chart I have a 50-day moving average, that would be the equivalent of a 10-week average. If on the weekly moving average I had a 40-week moving average, it would convert to a 200-day moving average on the daily chart. And the last section converts weekly to monthly and monthly to weekly. If I wanted to convert the weekly moving average of 13 onto a monthly chart, it would be 3. If I wanted to convert a 6-month moving average onto a weekly chart, it would be a 26-week moving average. You just put in the numbers where you have the highlighted cells, and it will calculate the conversion for you. It's a handy tool when you work across multiple time frames. You'll most likely find that you gravitate towards certain calculators over others, and that's fine. And you may not want to use the trading tools that I use. You may want to create your own, and perhaps this has given you some ideas. The main point I want to drive home is that it's very important to quantify and plan on the amount of money you want to risk before you get into a trade. It's also very important to keep track of your profit and loss while in a trade. You need to be aware of what a gain or a loss of a certain percent or R will mean to your performance. And you need to have a plan on how you'll add to trades in a responsible way. This is something traders who are serious about getting positive results should pay attention to. You want something quick, you want something convenient, you want something that can perform well in the environment that you're working. If you're a day trader, you need information quickly. If a position trader, you have more time to plan and prepare. So whatever you decide to use, make sure it addresses the important categories of risk and is something that you'll actually use. It looks like that's it for now. Thanks for watching. Good fills, everyone.